Hey everyone, this is Kirk here again at optionalpha.com where we show you guys how to make smarter trades. And today we're going to go over all of the trading alerts that we made for Wednesday, August 27th. So we had two new opening trades today and then one adjustment to a current position. So I want to cover that adjustment in IWM towards the end of this video. Before that, I want to go over both of the opening trades that we had both in Google and PFE, which is Pfizer. Now, as always, if you guys have any comments or questions about these trades, just go ahead and add them to the comment box right below this video inside the membership area, and I'll definitely get back to those. So the two trades that we made today are very, very similar in nature, and they're both debit spreads, but one is a debit call spread and one is a debit put spread. And we'll show you a little bit about why I made these trades and kind of the directional feel. But I like both of these trades, and they're fairly market neutral to have both of them on here. So we've got Pfizer, which is a call spread, and we want Pfizer to go up. And then we've got Google, which is a put spread, and obviously we want Google to go down. Now, with Google, let's start with that one. We went ahead and bought the 580, 575 debit put spread. So what that means is that we bought the 580 puts and then sold the 575 puts against that position. That gave us a total debit of 255. So just over mid price or half the width of the strikes, which is 250 since it's a $5 wide spread. So that gives us a break even point somewhere around 577 and a half, somewhere in there. Okay, so that's really where we have the break even on Google. When we actually go to the chart, you can see that Google's had a really, really tough time kind of regaining itself after this rally. So it's had a nice little pickup after the kind of market bottomed here a little bit short term in July, and now has started to turn back over and started to roll back over, and it's had a really, really tough time kind of gathering its feet. Now, technical wise, and I'll talk about this later on tonight on the coaching call and webinar with everyone tonight, but we did see a move down from CCI below that zero barrier, which gives us that very strong sell signal in Google. So this is one of the reasons, not the only reason, but one of the reasons why we decided to go a little bit bearish on Google instead of going bullish on Google. Now, with implied volatility down in the third percentile, it basically means that it's as low as it's been in the last year. So we definitely don't want to do any strategy that is selling credit spreads or iron condors, nothing like that, because we don't want to take advantage of implied volatility going lower since it's already as low as it's been in the last year or so. So we want to take advantage of implied volatility potentially going higher, which these debit spreads can definitely help with. But at the very least, we just don't want to be selling any premium right now in Google. Now, when we actually go to the trade tab, you'll notice that our position is a little bit in the money because at the end of the day with the move in Google. But the reason that I entered these strikes, even though they have very, very wide bid-ask spread, is because our break-even point, like I said, is about 77 and a half on Google. So with the stock closing today at 571, that puts our break-even price about $6 higher than where the stock closed today. And when we actually entered this trade, the same thing was held true. I think it was about $3 or $4 higher. Our break-even point was about $3 or $4 higher than where the stock actually was at that time. So if we go to the risk diagram here, I'll show you what I kind of mean with this. And we'll see here, let me kind of compress this out just a little bit. So this is what the profit loss diagram looks like on Google. Google is trading right now down here around 570. However, earlier today, it was trading up here around 574 or so. So when we entered this trade, Google was already in the money with our spread, which is great. And we make about the same amount of money here as we are risking. So if we're risking the same amount of money as we potentially make, but Google is already in the money, then that means we're taking better than 50-50 odds on this trade, even though our risk is 50-50, right? We're risking $250 to make $250, and with Google already in the money by the time we enter this spread, we're actually taking a little bit of better odds than the market is giving us a slight arbitrage opportunity, where if we made this trade consecutively time and time again and got the same type of pricing, then theoretically we should continue to make more money, even though it's a 50-50 bet, because Google is already trading in the money. Okay, so it's a slight arbitrage opportunity. You don't get a lot of these, and it's not a huge thing that you can take advantage of. You don't want to plow a ton of money into it. You still want to keep these things small, but that is exactly why we did the 580, 575, which was a little bit in the money for these strikes, but it gave us a really, really good break-even point in relation to where Google is trading. All right, so the next one that we want to go over is PFE, which is Pfizer. We did a 29.30 call spread for October in Pfizer. So that means that we bought the 29 calls, sold the 30 calls against them. That gave us a total debit of 52 cents. So again, just a little bit over mid price. That means that we want Pfizer to continue to move higher. If we go to the chart here of Pfizer, you can see it's actually kind of the opposite of Google, right? It's had its bottom and it continues to move higher up. And what we like about Pfizer is that it had a little bit of a breakout here today. So it had a very nice little pop higher. Volume was pretty good. It can sustain that move today. It didn't, pop higher and then drop during the day. And instead of Google, where we actually saw some of the technicals start to roll over, in Pfizer, we're actually seeing some buy signals start to materialize here, definitely with CCI, with the line or indicator crossing above that zero barrier, gives us a very nice, clear, potentially buy signal in Pfizer going forward. So we like this trade for sure, and we'll definitely keep watching it. It's a very small trade, as are all these debit spreads in our portfolio. They're still not very high probability trades, but coupling that with some technicals gives us some really, really good data to use going forward for directional moves. Okay, so the last one that we want to go over here tonight is the adjustment that we made to our IWM spread. So this is a very simple adjustment, so that for those of you who have the position, you can go ahead and add this adjustment in there. If you do not have the position, if you're one of the new members, we've had a lot of new members sign up this week. If you're one of the new members and you don't have this original IWM call spread, I don't suggest you add this put spread because it is an adjustment to a current position. It is not necessarily an adjustment that we would make as a brand new open order. Okay, so in this case, what we did here is we already had a call spread above the market, and we'll talk about this all in the Analyze tab. But now IWM is moving towards that call spread, so it's kind of testing us on the top side. So what we did to help reduce some of the premium or capital requirement, reduce our risk, take in more premium, is we added this put side to the trade, creating an iron condor. So we went in here, and with this vertical, we added the 114, 112 credit put spread. So it's a $2 wide credit put spread, took in 33 cents for each of these. We matched up the same width of strikes, $2 width of strikes, and matched up the number of contracts as the call spread. Now by doing this, by matching up both sides and having an even and balanced iron condor, we take no additional risk. In fact, we are reducing risk, and we reduce our overall potential max loss. So it's a great adjustment to make, because it gives us an opportunity to make a profit. We're not taking any more risk. There's no additional margin requirement, and it reduces our max loss should IWM continue to move a lot higher against our position. So it's much better than doing nothing. So here's a look chart-wise of IWM. You can see that it's starting to test those kind of upper boundaries. It's had a really, really huge move from the bottom and the lows back in the middle to end part of July. Had a huge move higher. When we actually go to the Analyze tab, this is what I want you guys to look at more than anything. You can see that this is our iron condor now in IWM. So we originally had on the top side, let me just kind of take these puts off. This is what we originally had with our call spread above the market. We had the 17.19 call spread. You can see that we had 3 contracts for each and a $2 wide strike on the call side. So now that the market has moved up and is now testing us towards the call side, what we did is went back in here and added a put spread below the market at 14.12, now creating this very nice tall iron condor. Okay, so that's exactly the mechanics of what we did. Now, before we made this adjustment, our max loss could have been $477, our max profit $123. Now that we've made this adjustment, our max loss now is reduced to $378 if IWM continues to move higher, and our max profit is increased to $222. So again, by making this adjustment, keeping everything equal, we actually reduce our max overall loss and increase our potential for a bigger gain should IWM close between these strikes now. So with that increased credit, that moves our break-even point out a little bit closer to 118 on the top side and just about 113 on the bottom side as far as the break-even. So we want IWM to close somewhere between about 118 and 113 between now and September expiration. So if we go back to the chart, that means that we've got a nice little range here between 113 and about 118 that we want IWM to close in. So a very good range that we could definitely use a move lower. That would obviously help this position. But if IWM continues to move higher, then all we'll do is roll up this put side trade again, take in more credit, roll it up to something like the 16.15. Again, continue to bank profits and take in credits. So as always, I hope you guys enjoy these videos. If you have any comments or questions, again, please add it right below. I'll definitely get back to all of those tonight or tomorrow before the open. And if you're watching this somewhere else on YouTube or somewhere else online, you just have to understand that these alerts and this video goes out to our members, but it goes out to you guys publicly about 15 days after it goes out to our members. So you're not getting these alerts real time. You're not getting this video the same night. And if you want all of that, you got to sign up at optionalpha.com. As always, happy trading.